So, you're looking for an Audit Fundamentals Masterclass. Well, you have definitely come to the right place. Today we're unpacking a complete beginner to professional journey, taking a massive 22-module syllabus and turning it into one streamlined explainer. We are going to visually break down everything from basic definitions and the true and fair view all the way up to advanced mutual fund audits. Let's just jump right in. Let's start with a really provocative thought. When you are looking at a company's financial statements, can you ever be absolutely 100% sure they aren't lying to you? It's a question that gets right to the heart of why the auditing profession even exists. You actually might be surprised by the answer, but to get there, we need to understand what an auditor actually does. To figure that out, we're going to map out our investigative journey across 6 distinct phases: bridging the trust gap, mapping the audit battlefield, gathering the hard evidence, hunting for red flags, delivering the final verdict, and finally, specialized audits and rules. Let's get right to it. Phase 1. Bridging the trust gap. Basically, why do audits even exist in the first place? Well, it starts with bridging that critical gap between the people who own a company, like the shareholders, and the people who actually manage it. The owners can't exactly check the receipts every single day, right? So they need a completely independent party to step in, evaluate the scope of the business, and verify those numbers. Which brings us right back to our opening question. An audit isn't just mindlessly checking vouchers or looking at every single receipt. It's a highly structured process designed to give what we call reasonable assurance to people like investors, lenders, and regulators. Basically, it means we are highly confident the financials present a true and fair view, but we are not providing a flawless, ironclad guarantee. And here's exactly why that is. Auditors provide reasonable assurance, not absolute assurance, because of the inherent limitations of the job. I mean, it is physically impossible to verify every single transaction in a multi-billion-dollar company. We have to rely on sampling, we rely on professional judgments, and frankly, auditors cannot predict the future. We can't guarantee that a perfectly healthy company won't face a sudden crisis tomorrow. But to maintain that trust and provide that assurance, auditors have to be fiercely independent, both in mind and in appearance, right from the very first engagement letter. They are constantly guarding against these 5 fundamental ethical threats. For example, a self-interest threat happens if an auditor secretly owns shares in the client. Or an intimidation threat occurs if a client threatens to fire the auditor just for asking too many tough questions. If you can't put safeguards in place, the auditor has to walk away, period. Phase 2. Mapping the audit battlefield. Before an auditor even looks at a single number on a spreadsheet, they have to deeply understand the business entity, the industry, and all the risks involved. They are essentially surveying the battlefield before deploying the troops. So the crucial point here is calculating audit risk. This is the ultimate danger, the risk that the auditor gives the wrong opinion when the financials are actually misstated. It's a combination of 3 things. First, inherent risk, which is the natural risk in complex areas like derivatives. Then, control risk, which is the chance the company's own internal systems fail to catch a mistake. And finally, detection risk. This is the absolute nightmare scenario, where the auditor's own procedures entirely miss the error. To manage all this massive risk, auditors use a brilliant concept called materiality. Basically, they don't sweat the small stuff. They focus their effort on errors big enough to actually change a user's mind. Now, this can be quantitative, like a $1 million error in a large corporation, or it can be qualitative. If a company director commits fraud for just, say, $5,000, that is qualitatively material because it tells you the leadership literally lacks integrity. During this mapping phase, auditors also heavily evaluate the company's internal controls. These are the critical preventive, detective, and corrective systems management uses to safeguard their assets. A classic control activity is a maker-checker system, where the person who requests a payment absolutely cannot be the same person who approves it. If a company has weak internal controls, well, the auditor's control risk shoots way up, meaning they have to do a whole lot more testing. Phase 3. Gathering the hard evidence. Once the risks and materiality are meticulously mapped out, it's time to roll up our sleeves, head out into the field, and start gathering the hard proof. Now, it's really interesting how auditors systematically test management's claims, which we call assertions. If management claims $10 million in sales, the auditor tests for occurrence by verifying dispatch proofs to make sure those sales actually happened. They test for completeness to ensure nothing was hidden, and they test for accuracy by literally recalculating the math and taxes on the invoices themselves. To test all those assertions, whether it's for bank balances, receivables, or inventory, auditors use an impressive arsenal of procedures. They aren't just sitting in a room asking nice questions. They inspect physical assets, they observe inventory counts, and they use analytical procedures to compare data trends over time. Most importantly, they know for a fact that an external confirmation, like a letter directly from the bank confirming a cash balance, is infinitely more reliable than just asking the CFO to print out statement. But listen to this, because there is a golden rule in this profession. Work not documented is treated as work not done. Literally, if an auditor performs a totally brilliant analysis but forgets to write it down in their working papers, legally and professionally, it never happened. Proper documentation is the absolute armor that protects the auditor's final opinion.
Phase 4. Hunting for red flags. We are now looking for the villains of the story, which brings us to the most intense part of the job. Actively hunting for major business failures and, of course, fraud.
Fraud is the ultimate red flag, and it's vital to understand how it differs from a simple error. An error is an honest mistake, a typo on a spreadsheet. Fraud involves intentional deception, forged documents, and sometimes management entirely overriding their own internal controls. Because it's deliberately hidden, fraud is incredibly difficult to detect. Therefore, auditors have to maintain what we call professional skepticism. It's this disciplined, questioning mind. They essentially become financial detectives, trained to look for very specific red flags. Are there manual journal entries being made at 2 a.m. on a Sunday? Are there massive, unexplained sales spikes right before year-end? Is a mid-level manager suddenly driving a luxury sports car that definitely doesn't match their salary? These point directly to the fraud triangle of pressure, opportunity, and rationalization.
Beyond hunting for fraud, auditors also hunt for existential threats by evaluating what's called a going concern. They are fundamentally asking, can this business even survive the foreseeable future? If they see massive negative cash flows, major loan defaults, or the sudden loss of a primary customer, the auditor absolutely has to ring the alarm bells for the investors.
Phase 5. Delivering the final verdict. After weeks, or maybe months, of planning, testing assertions, evaluating controls, and hunting for misstatements, we finally arrive at the culmination of the entire audit process. There are 4 possible types of audit opinions. Most companies get an unmodified opinion, which is a clean bill of health, but if there's a localized error, they get a qualified opinion. Now, if the financial statements are completely and pervasively misleading, the auditor drops an adverse opinion. And if the auditor simply wasn't given enough evidence, say the records burned down in a fire, they have to issue a disclaimer of opinion.
Phase 6. Specialized audits and rules. Let's just briefly look at how these core fundamentals apply to highly specialized, complex environments. Because while the principles remain exactly the same, the battlefield completely changes.
Take asset management and mutual fund audits, for example. Here, the risks shift heavily toward complex portfolio valuations and fund accounting. The auditor's primary job is protecting unit holders by ensuring that the net asset value, or NAV, is perfectly accurate. They have to verify that highly illiquid assets are priced correctly and ensure the asset management company isn't secretly trading outside their legal mandate, like front-running or insider trading. And because auditing and accounting are truly inseparable, auditors heavily rely on global frameworks to check this stuff. For instance, to verify revenue, auditors use the strict IFRS 15 5-step model. They systematically verify every single contract and performance obligation to make absolutely sure companies aren't booking sales prematurely just to artificially inflate their stock prices.
So, having decoded the auditor's journey from bridging the trust gap to mapping the battlefield, hunting for fraud, and delivering the final verdict, I want to leave you with this question to ponder. Next time you look at a company's financial statements, will you simply trust the numbers, or will you channel your inner auditor and ask, what can go wrong? Thank you for joining me for this complete explainer, and keep questioning the numbers.